Welcome to the Cash Flow Academy podcast. I'm your host, Andy Tanner. This is where we make investing simple. Got a great show on deck, particularly with the movement of precious metals in the market. Boy, you got silver popping, you got gold popping, new highs recently. We're going to talk about, boy, is it the top? Is it time to sell the gold, or is it time to say, hey, we're just getting started? There's always a discussion related to monetary policy and inflation when we talk about gold. So we're going to give a gold update. And we've got an amazing guest on deck. Brian London has been a publisher of one of the oldest, if not the oldest, precious metal newsletters. So Brian, first of all, welcome to the program. Thank you for spending some time to educate us today.
Very happy and excited to be with you today, Andy. Really looking forward to this. One of the things I try to do a lot is to explain to people who are new to the sector what gold is, its role as money, and how it really is and should be the center of the financial universe, and everything else, the value of everything else, should relate to this one standard. You just know that this is money, and this is economic freedom and protection from something, and it's insurance against something that we know is going to happen, that the purchasing power of the dominant currency is going to depreciate. And it's going to go away. It's going to lose value over time, something you know is going to happen, and gold protects against that. A lot of people don't realize it, but we were prohibited from owning gold. I mean, it was up there with heroin and plutonium as things you aren't allowed to for your own good.
Well, for the greater good. For the greater good.
So just accept it and move on.
I would just say that whenever the government labels something, you can almost rest assured that it will do the opposite of whatever that label is. I mean, Social Security is not secure. I don't know when the big everything bubble pops. I don't have a crystal ball on that, but we do know that, if the Federal Reserve had their way, you'd still lose 2% of your cash every year if they had their way. And they were losing it at a much greater rate than that. We had this transitory inflation that was supposed to just be kind of part of COVID, and we didn't have shipping lines open, and so we could, prices getting higher, we couldn't get goods and services. It brought a scarcity of goods, but once COVID relaxed, the scarcity won't, they'll be available again. Globalization will resume, and we get back to decent prices. Didn't happen. Now we have sticky inflation. In my opinion, the Fed's in a mess.
If you read the government reports, the GAO reports on the trajectory of the federal debt and everything else, I mean, it will make you walk out to the ledge. It is so depressing. But I'm here to tell you that those reports are sunshine, rainbows, and puppies compared to what the true story is. It's much, much worse. The trajectory of the debt is much worse than the CBO projections. It's proven to be over and over again. Typically, the debt has been doubling for every 8 years or 2 presidential terms since the 2000s. And it is really out of control. I've heard people for decades on our stage and other stages, and really smart people talk about the debt bomb blowing up, and it never did. Now I look at it, and the numbers are just absolutely inescapable. The interest expense on the federal debt has soared to over $1 trillion a year. We're paying more on interest than we are on any other single budget item. So the federal debt is out of control. Corporate debt is out of control. And all of this is the result of over 4 decades of not easy money policy, but ever easier monetary policy. One of the charts that I show in my presentations that I think says everything in one chart is the Fed funds rate since 1980, when Volcker just started lowering it from those peaks that he had brought it to kill off inflation. And you see that over that 4 decades plus, every time there was a recession or any kind of a hiccup in the economy, the Fed would have to lower rates. And then after that recession would go away, it would try to raise rates again to normalize it, but it was never able to get it past the previous midpoint of the range before it was forced to lower it again. So I put little red lines under each bottom of the rate cutting cycle, and you can see that over those 4 decades, it's a steady stair step downward to zero, which of course we reached in 2008. Over that period, the markets became addicted to that ever easier money policy, and the expectations came that interest rates were always going to get lower. The Fed was always going to come to the rescue. So you get past that crisis and you just go right back in, you blow up another bubble because the Fed was going to come back in. 2008, interest rates were no longer enough to satisfy the markets and the economy, so they came up with quantitative easing, TAR, a lot of other rescue efforts, et cetera, a lot of fiscal response. Then came, of course, COVID. And in COVID, everything that they did over 4 to 5 years after the great financial crisis of 2008, with COVID, they did it in 4 to 5 days, literally doubled the Fed balance sheet, came up with, not helicopter money, but direct injection of liquidity into bank accounts, into the veins, and monetary adrenaline injected into the veins of the economy. It was really just dramatically so much more than they did before. The next crisis, they're going to blow your socks off with whatever they come up with, because they're going to have to do much more than what they did before, because the addict has developed a tolerance for the drug, and it's going to take that much more to get the same effect. So the end result is you have that steady series of ever easier money, ever lower interest rates, and that encourages ever greater debt. And over that period, the other line that I put in that chart is the federal debt, which just rises tremendously. Now, the problem with that is you can never have normalized interest rates again, because now the debt is so large that even normal interest rates create a huge debt service payment that's unsustainable. So that's where we are right now.
And I don't think it's just the money that we've borrowed, the 30 trillion, is the money we've promised. Because when you make promises, those are liabilities as well. And the promises we've made in terms of income stability of pensions, medical dependency, healthcare, Social Security, you line all those up, you got a gross domestic product north of 20 trillion, but you've got promises north of 200 trillion. And those will just get bigger as inflation ensues. You talked about protection and insurance. And to me, that's where that's my mindset when I purchase at least physical gold. And so obviously I own physical gold. My mindset's probably different than most on this, so I'm going to get your take. Tell me where I'm wrong on this. But to me, it's a tremendous likelihood that will be fruitful insurance in the case of a massive devaluation of the dollar. If the dollar were to be devalued in a hyperinflation type of environment, your gold is historically, if you look at the tragedies of things like Zimbabwe and even Venezuela and Argentina and some of the South American countries, gold seems to be where a lot of people run to. So comments on gold as a protector and the idea of insurance.
Yeah, I tell people, especially people who are new to the sector, that there are 2 reasons to buy gold. One is insurance, and one is as an investment. And you always need that insurance. If you relate it to your home insurance, you don't really expect that your house is going to catch on fire or get hit by a tornado, but you're insuring against that possibility. With gold, you're insuring against an inevitability, and it's not necessarily just about hyperinflation or anything else. It doesn't have to be anything on the extreme. Do you feel confident that in 3 to 5 years, the dollar is going to buy significantly less than it is today? And I think everyone would say yes. Even at 2%, it would, but at current levels, it definitely will be worth a lot less in 3 to 5 years. Gold protects against that. It doesn't track inflation tick for tick, but over time, over the broad sweep of time, it protects value, and it's only done it for 4,000 or 5,000 years, so you can pretty confidently project that it will continue to do so. And you made a comment earlier, Andy, that I think was very important. You said you don't know whether the blow up of this system is directly ahead or not. I totally agree with you. I don't think anybody knows if it's the next crisis or the one after that or the one after that. Which one or at which point does the currency lose all of its credibility in the public mind? I mean, they start to realize that these crises are coming at regular intervals and the money gets a lot cheaper with each one. At which point does the currency lose credibility? I don't know what that exact process is. I don't think anybody is smart enough to know, but I think we can be confident that you're going to want to own gold and silver going into the days ahead, because we may not be at the end of the process, but we're in the end game right now. We're at the point where you can never have interest rates sustained over the rate of inflation, or the whole house of cards collapses because of the debt service costs. So we will have negative real rates going forward as long as we're under this monetary regime.
It's interesting. You look at the resistance. If you're a technical analyst in the Bernanke years, people bought a lot of gold, particularly silver too. Silver just went through the roof. Yeah. And gold. Let's just put gold ceiling around 2,000, and it hits up against that. It's a new high. The old floor was 1,000, so you basically had a doubling from the old floor to the new ceiling in a macro, in a long-term chart. The feeling I have, now that it's blown through 2,000, often the old resistance becomes the new support. I think 2,000 is now the you're not going to see gold under 2,000 again. That's my opinion. I could be wrong. I'm really good at being wrong. So when I say stuff, but as a technical analyst, that's kind of that's the textbook idea that the old ceiling becomes new floor. But it's different this time. The idea of it hitting 2,000 the Bernanke years was really a speculative idea that, we're going to do this QE, we're going to lower interest rates. I mean, obviously this is the demise of the dollar, and people bought the hell out of gold and silver, and up it goes. Didn't happen, didn't sustain, dropped back down for, till now. This is 15 years or whatever it is. The feeling of it going up this time, though, is a result of real inflation to me. I mean, now a person goes to a grocery store, you can't get out of a grocery store for under $100 for buying just a couple of meals. So I think the Fed has not kicked the can down the road. I think a better metaphor imagery would be rolling a snowball up a hill. It gets bigger and it's higher. Talked about gold as insurance. Now, when I buy insurance on my home, I say goodbye to that money. It's a cost. When I buy insurance on a car, I say goodbye to that money. I don't expect ever to get a windfall from it, because if I do, that means hell broke loose. If I make a claim on any of my insurance policies at all, something in my life was bad. So what's weird is I would prefer to have that expense in my life to sleep at night, but never have to make the claim. So if you see me selling my gold, it wasn't a good day, right? Whatever's happening was not good news. If I'm having to sell my gold for what I really need in my life, I don't need gold. I need food, clothing, shelter, and medicine. That's what I need. I need commodities that are consumable, and certainly, gold and particularly silver can be used they have the industrial uses. So I say goodbye to that. As an investment, I struggle more with gold. I really do.
Well, I think everybody, and this is what I tell people who are new to the sector, again, I said the first thing you do is get physical metals, get your insurance in place, because that's something that's going to happen and you need to protect yourself against. The other key aspect of that kind of insurance is, unlike home insurance, car insurance, you only have to pay the premium once for gold insurance.
And you get to pass it off to your kids, hopefully.
Yeah, and it stays, and it protects your wealth for you and your kids and your offspring, et cetera, and your family. The other thing is, though, if you look at the history of gold versus the dollar, basically the gold price, you see that for a lot of times in history, gold just trades sideways because nobody's really worried about the dollar. But then when people really get worried, then gold makes up for a long time and pops and probably overshoots equilibrium. When you're approaching a period like that, when you see that the macroeconomic picture has gotten to such an extreme that you're very confident that gold's going to start making up lost time and go through one of those big surges, then you can look at gold as an investment. And there are ways to do that where you can either do it with greater liquidity and or leverage as opposed to just holding physical bullion. You can invest in ETFs, paper representations of gold, not for insurance, because if you don't hold it, you don't own it, you don't own it. You can't rely on the paper representations for that insurance. But still, for liquidity, you can invest in things like the Sprott Physical Metals Trust for gold and silver, even platinum, palladium, and uranium. And you can hold as paper representations, and you can trade those if you like. You can also leverage them through gold mining stocks, which is a whole nother area. It's one of the areas that we focus on in Gold Newsletter, talk about junior mining stocks that offer a lot of potential, but it is not for widows and orphans. It is a risky area, and you don't want to go into that area without doing your research. The advantage is it's an inefficient market, so if you do your research, you can outperform. If you're not interested in doing that kind of time and effort and money to learn about the sector, then you can invest in the indices like GDX and GDXJ and the like that cover gold and silver miners. And those tend to outperform the metal. In a typical gold bull market, those indices should outperform gold itself by 2 to 4 times over time. And that's another way to do it. And of course, there's features and options, but that's another very risky area that you really have to educate yourself on.
I'll tell you, I my physical gold, I've kind of kissed that money goodbye. I will probably not see it in my lifetime unless we have a tragedy. It's an insurance policy. If you ask me my preference for the metal, it'd be for my children to inherit that metal. That would be the ideal, but I have to be ready for the fire. I didn't buy more gold recently because I think I have a lot. I got a lot of precious metal. It doesn't cash flow. It doesn't give me, income. It's not a goose that lays golden eggs. I've had mining stocks for years. I bought a whole bunch more of that on February 17th of this year. I bought a bunch of Newmont mining. Yeah. And I think it was probably around 34 or something. Now it's in the 40s. That's a nice capital gain. But what's more important is this. I'm not a buyer of gold. I'm a producer of it. Mm-hmm. And by owning those shares, I now own a share of every single freaking ounce of gold that will ever be pulled out of that mine forever. And I own real estate now because we own the mines, or at least have mineral rights to these mines. And as gold goes up, it's a lot like oil. You have lifting costs that remain fairly stable, a little inflation there. But as the price of gold, if what I'm selling goes up, now I have my pile of gold for insurance of my own, but now I'm selling it. And if you want to get rich in the world, learn how to sell stuff. I sell books, and I'll tell you, I've made more money from the books I've sold than I've ever made from the money for books I bought. I make more money from the gasoline I sell through owning ExxonMobil than I ever get through buying it. Anything wrong with owning a mining stock like Rio Tinto, and anything wrong with Newmont Mining and Barrick Gold of being an owner of a mine? That's a goose that lays a golden egg. And anything wrong with selling options for cash flow as I play the gold game? Anything wrong with that?
Nothing wrong with that, but it gets back to what we were talking about, the difference between insurance and investing. And you're coming up with some brilliant strategies to make money in the sector, even when you don't have a rising price.
Bingo.
First off, insurance, make sure you have that physical that is insuring your wealth. And it really depends on your personal level of comfort on what that is. But when you get into the investing angle, there are a lot of ways to do that. And you had mentioned that the last bottom for gold was about $1,000. I marked it at $1,040 in 2016. And if you look at the history, we're in uncharted territory right now, record highs for gold almost every day. So where are we going? If you look at the history of gold as an investment, as an investable asset, it only goes back to 1974 in the US. So you look at that period, you had two bull runs in the 70s. In one, the gold price went up 6 times. In the other one, the gold price went up 7 or 8 times. Then in the 2000s, it went up about 8 times. So if you look at the bottoms and you figure that this next gold bull market is going to do similarly, somewhere between 6 and 8 times the bottom, well, the bottom this time was around $1,000. So at the end of this cycle, however long it lasts, 3 years, 6 years, 10 years, whatever, the gold price should be 6 to 8 times that $1,000 bottom. And that's where we're going to be heading. So then you go into how to invest. You mentioned people bashing GLD. Well, I'll bash GLD and I'll bash the silver ETF SLV. You look at the custodian of those funds, and it's JP Morgan, whose metals trading desk was called a criminal operation by the Justice Department. So I advise the Sprott Physical Bullion Trust, because Eric Sprott, who started that, is absolutely a fanatical silver and gold bug. He buys the metal and doesn't think about loaning against it, doesn't think about using fractional reserves or anything like that. It's antithetical to him. It's heresy. So he has a physical gold bullion trust, symbol PHYS, and he has a physical silver trust, PSLV. And I recommend those. And they're supposedly, because they're trusts, there's some tax advantages, but everybody has to personal tax advisor for that.
If you ask me where Apple's going to go tomorrow, my answer is I have no idea. If you ask me where Apple stock's going to go in 2 weeks, I say I have no idea. And if you ask me where it's going to be in 10 years, I say I have no idea. I think it'd be up because of inflation, but I don't know. I just don't have a crystal ball on that stuff. But I'll tell you what, if you ask me where I think the dollar will be in 20 years, I know exactly where it's going to be. It's going to be lower. So the problem with investing, one of them is you're always trying to predict the future. So you're caught in this paradox of constantly trying to do something that can't be done, with one exception. I literally bet the dollars in my wallet that they're going to lose value. And I think that if you can understand that there is something that I do believe is inevitable, and then the Fed's lost control of it, but even if they had control of it, they're still targeting a 2% reduction. That's their goals. Now is a very important time. Your greatest asset, I think, is education. If someone is not invested in gold opportunistically or invested as a hedge, what would you be your last word for those guys? Are any baby steps where they could start and realize it's not as scary as they think?
Yeah, buy physical metals, buy bullion, don't buy collectibles, don't buy rare coins, don't buy proof modern issue coins or any of that. Just straight bullion coins. Don't pay more than 3 or 4% over for 1 ounce over the spot melt value. Don't pay more than 6 or 7% there or thereabouts for silver. Buy it, hold it, have it accessible to you. That doesn't mean a safe deposit box, because one of the things you're insuring against is a bank holiday, and the banks don't want you to put it in there, frankly. Figure out how to store it and safely, get a home safe if necessary, an alarm system, etc. Don't tell anybody, but own it, protect yourself, and then investigate ways to leverage those that insurance. Look at it as investing and educate yourself on the sector, because again, we don't know the precise path ahead, but we know the direction generally that we're heading. And you want to own gold and silver and related investments. So don't sit on your hands. The time's a wasting. And as we're seeing, these trends are starting to converge, and we're in the end game of a long cycle.
If you've read a book like Rich Dad, Poor Dad, and your asset column isn't what you want it to be, maybe you're new to assets, maybe you don't have any. I told my sons, I said, buy some ounces of silver. That's a great way to start. It's not expensive. You can buy some silver and say, well, I have an asset now. And, you know, people buy insurance for their home. And I'd ask these people, what do you think the chances really are that your home will burn down the next 5 years? What do you think the chances are? You could look it up statistically and see what that is. And yet you're going to spend thousands of dollars insuring a home against something that will likely never happen. Well, you also have a similar amount of money often in a 401k. Where's your insurance? What's more likely to burn down the next 5 years, your home or your 401k? Having a little silver there, having a little hedge in there, little gold in there, whatever you want to invest in. Entrepreneurship and investing is a journey of personal development, of discipline, temperament, and knowledge.